Hey there, everybody. Welcome to the Presidio Perspective podcast. My name is Dustin TenBroeck.
And I'm Luke Jacobson. Good to be with you guys today.
Yes, thanks for coming back. So we got a lot more to talk about. There's been some mania out there, so we want to talk about some Meme Stock Mania today. Quickly, hopefully, but it's something that I think we should discuss, right? We're getting a lot of calls on that, and hopefully we can shed a little light of what's going on in there. We also want to talk about some of the different things we're looking at as far as your portfolios, the non-stay-at-home trade and the resurgence of that. Also looking at some big news and some big tech companies out there with assets, liabilities, income, expenses, how they're managing their balance sheets, what that means of how you might want to manage yours. Also the down and out trade. Okay, so Luke will tell us more about that at the end of the show. Important thing to keep in mind for our portfolios. Meme Stock Mania. We also have a Super Bowl Sunday coming up. So
who's playing?
So Luke, I understand you're from Kansas City. Sierra here behind the camera, who you can't see, is a diehard Kansas City fan. She's also from Kansas City. So let's see. I have no idea what the room is feeling for the Super Bowl.
Yeah, I don't. I actually have other plans on Sunday, but no. Even my 11-year-old daughter, got her fingernails painted in Chiefs gold and red.
Yeah.
So there's some excitement in the Jacobson house this weekend. That's for sure.
Wouldn't it be just the total end of the conversation whether Brady is the greatest of all time if he actually pulls off? I mean, it's his 10th Super Bowl.
It's pretty amazing.
I mean, that really alone is amazing.
It is.
He goes out. Did the Buccaneers make the playoffs last year? I don't even think they were in.
No, it's been a while.
And he leaves the New England franchise, and here he is in the Super Bowl. And what if he won? I mean, that would just... Yeah. So either way, I wasn't too excited about the Super Bowl. I'm being a 49ers fan, of course, and,
sure.
Losing to your Chiefs last year. And we weren't anywhere close this year, but should be interesting. So, but not making any bets, I don't think.
We are looking forward to it immensely. And I don't know if you noticed, but there was even they dodged a bullet yesterday. Pat Mahomes almost got his hair cut by his barber. His barber tested positive for COVID-19.
Oh my gosh!
He just missed it. So we just about missed Mahomes.
Yeah.
In the Super Bowl.
Gosh, yeah, you gotta be worried about COVID here. If you're running an NFL franchise, going to the Super Bowl, and you lose your star quarterback to a positive COVID testing. They might bend the rules on that one, march him out there. I'm not sure.
I don't know.
Yeah. Yeah, and there's been, we should stick to the script. I want to get to the vaccine rollout, too, so we got to weave that in here sometime. Luke, obviously, that's a big thing that's going on here in the markets. But Meme Stock Mania, so what happened? We had this company, right, this company that seemed to be, playing games.
Playing games.
And they weren't playing the game too well, and they were going out of business. And all of a sudden, their stocks started skyrocketing because of a Reddit, stream of Wall Street. It's a thread on Reddit, right? It's a popular social media website. Found an opportunity and capitalized on it.
Right. I mean, you basically had a lot of investors get together, decide to act on the same trade, and really just worked against how the system works.
Yeah.
With contracts and short selling and margin. We've heard all this before for probably over 100 years. I heard someone cite, I don't know the history specifically, but I heard an individual Art Cashin cite a similar short squeeze in 1902, I believe it was.
The famous 1902 short squeeze. Is that what he was referring to?
The difference is back then you would have run across probably, cobblestone streets into smoke-filled rooms and book your trades on a ticker
That was
tape.
the social media of the day.
Right, that was the social media
right,
back then.
Right.
So it is different. What's really different about it is how fast data can be mobilized now, how individuals and ideas and different groups of people can mobilize a system. And so I think that's definitely part of our market. It's just moving faster.
And you're much more of an expert on markets and financial derivatives than I am, but I did want to just take a moment to explain that to some of our listeners of, what is shorting a stock and why did that matter, right? It's essentially, you can take a company and you can sell those shares today, even if you don't own them. And the idea is you think the company's stock price is going down, right? So if I sell them today, with the idea that I'm going to buy them in the future at a lower price, right? So if I sold up here Time goes by, the stock goes down, I buy them here, which kind of completes that contract, right? So that's a profit, right? Because I actually bought low and I sold high, and I just did it in the reverse. That's what shorting a stock is.
That's right.
What happened, and what these really clever, whoever you want to call them, were novice investors. I mean, retail investors, very smart. They figured out things that is just amazing that the smart minds in Wall Street did not figure out, is that more people were selling short, right? Selling the stock that they didn't own than there were shares to buy in the future.
Right.
And so what they recognized was all of this demand had to buy in the future. There was this demand of future in this one company that they would force to have to buy. Well, supply and demand, if you have to buy, the price goes up. So they bought all the supply of this stock. And so when these short sellers had to kind of fulfill that obligation, they had to buy from them at now an elevated price.
Right. And
that's just really smart that they figured that out, right?
It's
really
smart,
intelligent.
It's smart that they found a data point. They were able to quickly mobilize on it. Now, underneath all of this headline data is the reality that institutions and individuals can loan out their stocks. If you actually hold the security, you can loan out your stocks and make money on that. And so through that process, your custodian is supposed to find a locate. So when somebody says, I'm going to short ABC, they're actually supposed to locate that stock. And what we find is that they actually don't do that very well. And that's how that short interest became over 100%.
Yeah.
And so so what happens when you borrow a stock and somebody sells that stock? You can no longer borrow that stock anymore.
Right.
Your stock is called. And so that becomes sort of a self-fulfilling prophecy when you borrow a stock and somebody actually sells it out from underneath you.
Yeah.
And then you have to buy it back in a condition that you didn't anticipate.
Right.
Now, not to mention, all of this is now reversing, and what was must-see TV 7 days ago almost seems like just a ripple in a giant, large ocean.
Well, and it's it's sad for those who got into the stock as it rose, right? Which is what typically happens. And so, look, there's lessons that we can draw from these things, just like we did from 2020 and coronavirus and what the markets did. Draw the conclusions and lessons here too. I mean, this euphoria and mania creates this buzz, and people pile into a stock that is, for all intents and purposes, going bankrupt, right? I mean, that's the strong likelihood.
So absolutely. So there's two things I would add to this. So the market value of this particular company we're referring to is 0.004% of the overall stock market.
Okay.
So it took up 150% of mind share for the
the
last 7 days.
Right.
But really inconsequential to the overall value of the market.
Which is what made it such a good target for this manipulation.
Well, right? and the follow on that is there is contagion risk. And we won't go into contagion risk, but just think of it as a waterfall that could fall into another pool and another pool, and instead of only affecting the 0.004%, it starts to get bigger. That goes back to 1998 with long-term capital management. For those of you who want to Google that right now, that's what people were really worried about with that contagion risk.
Right.
Now, speaking of a company that went up that shouldn't, another scenario was announced today. So there was more than one security that actually went up in tremendous value.
Right.
And one of those companies, the family that owned it, sold all of their shares last week and made a fortune off of it.
Yeah, good for them.
Almost 10 times their money.
Good for them. So a lot of money changing hands, right? I mean, there is just a lot of money changing hands, but companies necessarily weren't changing value, right? I mean, on paper, and this was just really shuffling of wealth in between investors, and the companies were kind of just the conduit to make that happen. And yeah, I think you hit it earlier. It exposed some inefficiencies in our current clearinghouses and custodians, right, in the way that we transact some of this business. That need to be addressed, right? And I think Yellen is going to be one of those to address it. I mean, you have Elizabeth Warren out there wanting to address this also. So you're gonna hear more about this. But I think there's lessons that are going to be learned, right? You could have contagion, like you talked about, but it also could be shining a light on something that on a 0.006% of the stock market, right, to prevent something that actually would matter, right?
Yes.
And so we're actually going to start addressing this issue on this really small item. That's a positive outlook. The other thing I think it does is it really, and which we don't have time to cover today, since we're running over on this segment, but decentralized finance is a method in which it kind of solves its problems as it goes.
Correct.
Right? And so I think for me, when I'm looking at this and this whole fiasco with Robinhood, Discord, Reddit, these companies, these non-publicly traded companies that have had that have been involved in the news, and some of the problems going on here is, what does this open up for decentralized finance and cryptocurrency, and what could be possible there?
Right, and that, I feel like we're just at the tip of the iceberg. The other exciting point, and this will be the last, I don't really want to dig into this very far, but one of the most exciting things about the must-see TV last week is it just eliminated any presidential mania.
Wasn't that nice?
It wasn't. It was the greatest thing ever to not see anything about politics whatsoever.
Yeah.
So I was really excited.
That is good. That is good. Nice. Positive outlook. All right. So, Luke, you want to tell us a little bit about the January PMI numbers? First of all, what those are, why we should care, and how that should affect our portfolios, or how it may affect our portfolios.
Right. Real simple. First of every month, there's a Purchasing Managers Index that's put out by the Institute of Supply Management. Effectively, what they do is they call out to a lot of individuals and they ask the question, how's your business doing? Is it better or is it worse? And if the number is 50, it's the same. If it's above 50, it's growing. If it's below 50, it's shrinking. It's a diffusion index. And in January of 2021, the ISM manufacturing, so not ISM services, United States is more of a service-based economy recently. So manufacturing is a smaller component of our overall GDP. However, it grew at a rate of 58.7, which for those of you not familiar with the number, that's a really high number. It's actually
so
really high.
Above 50 is growing, right?
Above 50 is growing, and it's really hard to maintain a 60.
Yeah.
It's really, you can't continue to grow. If you grow that fast, then manufacturing is going to turn into the U.S. economy. Okay. So it grew really fast. And I'll just read. It's a really long report, but I'll just read one part of it. They do what respondents are saying portion. I'll just read this quote. It says, our current business demand is growing way past pre-COVID-19 levels. And that's from the fabricated metal products section. Now, when I think about the United States, I think about tech. I think about Silicon Valley. I think about large gross margins and really, really exciting services businesses. So this is just a component that I personally would have expected to slow down as we shut down the world again for COVID-19, and we didn't. And later on the next page here is commodities reported in short supply. Copper, corrugated boxes. I wonder what that's from, right? Corrugated boxes, for many of those receiving maybe packages at your front door.
Right.
Freight, steel, semiconductors, and we're seeing that in the market.
I think my household could help handle that shortage in the corrugated boxes if I got to just step out to my garage. I think many of you could probably attest to that too. So maybe we should band together and make a trade there. But yeah, I mean, also this is coming off of a pretty low number, right? So we would expect, we did expect some growth in this number, right? I mean, this is where we've been talking about, the U.S. economy opening back up as vaccines roll out. And so, part of this growth is kind of preparing for that, correct?
It is, but remember, it's month to month. So it's not year over year, it's month to month. So you could have a 0.58 in December and easily have a 50 or a 49 the next month, especially if the world says, we need everyone to go home again like California did.
So this is what we call a leading indicator.
Yeah, this is definitely, it's leading to coincidence. There's a lot of leading indicators in here about inventories, and I can tell you right across the board, this is a very, very bullish report, and you can see the market react exceedingly strong as of Monday.
Okay.
This report was a big deal.
Let's come back to this next month and make sure we touch on this also.
Sure.
So we have new February, or what, next month, this month, whatever.
Sure. That's
we
right.
are.
Already
Time's flying
there.
through. It's going to be 2022 before we know it. So what does that mean for our portfolios?
Well, so meaning I'm going to shop on and I'm going to have my food
You're going to ride your bike. You're going to shop on your website.
So I think I've come to the realization personally that we're not going to go back to the past, but we're also not going to live in this perpetual state of COVID forever. It's going to be sort of a hybrid model. And so what's really interesting is that as we continue to open our doors, step outside, and find out what this new world is, that there's more to capitalize in our portfolios than just simply stay-at-home stocks, and they're at better valuations, at lower risks, and it also works specifically with the down-and-out trade, which we'll touch on segment 4. So it's exciting to see, and it's really good for employment.
Yep.
It's very strong message for the U.S. economy.
Yeah, wonderful. There was some interesting news that we just kind of wanted to weave in here. You know, it came out this week. Big tech company it did a bond issue and borrowed, I think it was $14 billion. And a big company that was in no need of any cash, right? Billions of dollars in cash on the balance sheet, and decided to borrow money to buy back its own stock. Mm-hmm. And I thought that was really interesting. You know, when you are the largest company, right, on the U.S. stock exchange, you know, how did you get there? One of the things I like to say is, if you're one of the biggest companies on the stock exchange, you must be one of the best companies, organizations on the planet at making money.
Sure.
Right? I mean, how else do you get there?
Right.
That's it. And so, so if you are the best at making money, us as financial advisors or wealth managers or managers of our own financial households would want to pay attention to what those CFOs and organizations do, the decisions they make with their balance sheet. And understand there's obvious contrasts and differences. But, you know, one of the things that we talk about in our retirement courses and in our financial planning with our clients is A.L.I.E, right? Assets, liabilities, income, expenses. The only 4 variables of finance. And these very large, successful companies get that as well, and they only have these 4 variables also, right? And so when a company decides to increase liabilities by $14 billion, and not to mention they have billions of dollars sitting in their bank account. So this would be akin to somebody today with, you know, extra, you know, hundreds of thousands of dollars in their cash bank account, and then going and taking a mortgage, even though they don't need the money, and investing that money in assets on their balance sheet. That's essentially what this company did. And so I think it's important that we take note of that, right? Well, when we're making our own decisions, you know, we talked about how low mortgage rates are, right? And that where they're probably going, and the opportunity on inflationary assets of investing. And so it's just time for people to look at their balance sheets, I think, just like this company did. And I'm theorizing that this company says, this might be, if we're going to borrow, I don't need the money, but I certainly don't want to borrow in the future. I don't want to borrow when rates are higher. I want to borrow when rates are lower, right? So 2 ways that we can invest. We can own or we can loan, right? And I want to lend, right, when rates are high, right? And so I can own things when rates are low. And there's just those 2 different sides of the balance sheet.
Well, and what we talked about right before walking in this room, just about the state of markets year to date. So this particular company is selling bonds. They're selling a bond and receiving cash.
Right.
And the performance of the aggregate bond index, down 1% year to date, while the stock market is up 3%. I mean, you can just extrapolate that trade that this company's making with what the market dynamics are, even just on a year-to-date basis.
Yeah.
So the market in general is looking at, I'm not getting a return on my aggregate bond index. I'm getting return in equities. And by the way, this is exactly what the Fed wants us to do. They want economic momentum created by risk-taking and the money multiplier expanding by putting capital into the market and have it run through.
I mean, I was talking with a client yesterday, and we were looking at their balance sheet and discussing, you know, should I refinance? And it was kind of a similar situation where there wasn't any need for cash, but maybe just as a way to better structure the portfolio. And we talked about, you know, what question you asked me last time, right? What was the most you ever paid on a mortgage? And she said she remembered her parents, right, in the 70s investing at 21% mortgage. 21. And I've talked to clients in the past, that's as high as I've ever heard it, but I've talked to clients in the past who recall having a 16% CD. CD, certificate of deposit, right? In 1984, 85, somewhere around there. And so, you know, a lot of you have lived through periods of inflation. So when we think about, you know, what this company is doing, they're borrowing money, right? You can borrow at 2 or 3% today, pay that money back 15, 20, 30 years into the future. What is money worth 15, 20, 30 years into the future? A lot less than it is today. So I get to borrow the valuable money today, pay you next to nothing in interest, and pay you back over a 30-year cycle. Sure. And what should I do with the money? I mean, we're just like, well, what do you think the average money market would earn over the next 30 years? You know, I mean, we're theorizing here, but if you looked at the average money market over the last 30 years, it was a lot higher than 2 or 3%. I mean, that's probably where it's been for the last 5 or 10. But, you know, when Tom Brady was in the Super Bowl in 2007, okay, average money market account was 3.7%.
Did everything just come back to Tom Brady?
It always comes back to Tom Brady somehow. But 3.7%, Luke. I mean, imagine if you had a 30-year mortgage at 2.7, and that same bank's paying you 3.7. Gosh, that would be a great trade. So anyway, we're looking at these big successful companies. We should take note of what they're doing. They're pretty smart with their finances. We want to be smart too. So something we just wanted to take a note on. So, yeah.
And speaking of successful companies or basically big market moving events, something else happened this morning that was pretty interesting. So
I thought you were going to start talking about Presidio, but go ahead.
Well, yeah, for sure.
Yeah.
So there's been a phenomenon in the last 18 months, say, where you've had a lot of companies start coming public through a SPAC process, a special purpose acquisition company. And today was a big short seller group put out a negative report on a SPAC that had just acquired another healthcare business. This business is actually sponsored by a SPAC by Chamath Palihapitiya, who's actually had a really great track record with SPACs. But it's really shining a light on the process of special purpose acquisition companies, how they bring capital into the market and companies in the market. And I just went ahead and printed off the Securities Act of 1933 and why it was created. It was very interesting. It was also established laws against misrepresentation, fraudulent activities in securities markets. I mean, it was basically to protect investors after the crash of 1929 and established all these rules and regulations about how to bring capital to market and how to disclose. And I've had a lot of experience at looking at SPACs in, I would say, previous generations of SPACs, but I just found it very interesting, and I bring it up today because it was something that really hit me. As every once in a while something happens and you think, that's really important. And to me, that was something that really shot across the bow that I'll definitely be paying attention to. I've been waiting for something like that, but there's a lot of money chasing not as many opportunities.
Yeah.
And we'll find out kind of how that plays out.
Yeah.
I think it's important to talk about.
Thanks for bringing that up. Let's track that. Well, let's get to a segment that I know that you're very passionate about, and so it's our down and out trade, right? And so this is, I think, something that's really interesting and something that we're looking to capitalize on our portfolios here at Presidio. But what does down and out mean?
So down and out does not mean what you think it might mean, which is we're just buying garbage or trash on the bottom of the floor. Down
or
and
that
out.
You're out of the game. You're down and out. Or
It's
you're
actually
depressed.
quite opposite. So down and out is a trade that here at Presidio we've put on in the last, I'd say, 60, 90 days. And it basically means down in size. And
So from large cap down to mid, small size companies.
that's right. So like moving exclusively from large, even some of the largest S&P companies who have had extremely momentous years over the last 3 years in stock price.
Yeah, or 5 or 10 for that matter, sure.
And moving and looking and seeing what are the availabilities of securities that are down in cap.
Okay.
And so you're looking at small cap, you can look at the Russell 2000, or even micro caps.
And these are companies that are going to be more sensitive to the U.S. economy. Is that right?
Sensitive to the U.S. economy, more sensitive to economic growth.
Great.
Substantially, their momentum for many of them is created less by themselves in cases and more by economic growth. And so these companies can do well, and they'll benefit more from what's happening in sort of with the dollar trade and what's happening international.
Okay.
So the environment with policy and our government is actually helping small caps as well. And so people are moving down in cap because, one, they haven't performed as well over years. They started to take leadership in about November, October of last year. And that leadership has just continued in momentous fashion. The small caps are up on average, don't hold me to it, but it's almost double digits.
Yeah.
With the S&P up too. So the trade has been
Since when?
substantial.
Year to date.
Year to date has been substantial. So out, what does out mean?
I
So
can
out
fact
doesn't
check
mean
you right
sell.
here while you finish that.
Yeah, out doesn't mean sell. it means outside the United States. So a lot of that has been based on the dollar being weaker. And so if you just had a constant
11.4,
trade,
good job.
right? Yeah, if you had a constant trade and the dollar was weakening, if you were invested overseas, you would actually just get a return on that trade just with the dollar weakening.
Yeah.
And so that's happening. And then I think we have to take a step back, and I don't really cheer communist China, but I will say that there's something about their government process that is highly effective at managing a pandemic. And I think you have to really look at that and say, when the people say, sure, tell us what to do, we'll go ahead and do it, versus what we do here in the United States, which is, please give us our freedom. That actually really helped them during the pandemic, and they are way ahead of us in GDP growth and fixed asset investment, and that is actually a place where people are really looking to put capital into, not only in China, but even in emerging markets.
Yeah. Yeah, and we could go off on a tangent about how much those people say, yeah, tell me what to do, versus they don't have a choice in the matter, right?
Very true. I'm not condoning communism here,
right.
But I am looking at the numbers and saying there is a unique circumstance and how that actually worked really well. I remember looking at a map in November, and effectively it seemed like where the virus started was nearly eradicated, at least on data.
Yeah. So, I mean, I've heard a lot of complaints just in my own neighborhood, right, about California and our governor's policies
what sort of complaints?
On lockdown, right, and what we're allowed to do as far as children going to school and sports and all of that kind of stuff, restaurants, et cetera. So imagine that times 100 is kind of what you're dealing with at China, right? And so there's massive lockdowns in what you can and cannot do. There's curfews, all that kind of stuff, right? And so you really are stripped away from your freedoms. However, that is very effective in combating a virus, right? And so
it is, and
it's not right.
That's happening in conjunction with a brand new 5-year plan. So those of you who may not be followed what happens in China and how they dictate their policy, they look at very, very long-term time frames, and then they put out 5-year plans, and they effectively tell you what they're going to do, and they execute pretty aggressively on that plan. They put out a 5-year plan, and not to get too deep in the details, but they highlighted technology. I think that's very interesting. As of today in the headlines, we're looking at shortages in semiconductors. I happen to be looking for a new car. That is not fun, given that they're shutting down plants everywhere.
Right.
That is, inventory is tight, semis are in demand, and China wants to be a tech hub.
Yeah.
And so they're putting that together. In addition, they're actually looking to open up their economy. They're actually looking to open it up, whether that's from investment or people to have more freedoms and investing within the state under some control. It's a big change.
So lots of interest and things, reasons why we want to look at China then, it sounds like, as a potential place for investment. And then emerging markets, you mentioned semiconductors, and so just, the whole Southeast Asia has a great, stronghold on that sector, and certainly it's going to be in demand. So lots of companies abroad we think could benefit, and those companies just get an added boost for U.S. investors if we do experience inflation, right? So we do, not only are you talking about some of the fundamentals and kind of economic forces that could, give rise to these companies overseas, but also just having that inflation trade for U.S., it gives an added boost to those companies abroad.
It does. There is the scarcity value of so many items right now is about to, I think, make demand just absolutely erupt.
Yeah.
I think it's going to scarcity value, whether it's scarcity for a reservation this Friday night at dinner, or a plane ticket to Hawaii, or a hotel room, wherever it is, the scarcity value of everything that we've all been waiting to do is going to present itself in really unique ways over the next 6 to 9 months. I hear people talk about the roaring 20s. I'm not really going that far. I just look at my own anecdotal evidence and looking at what stocks are doing. And the market's definitely saying that even after the huge bull run we had for the last 10 years and then the nice reversal last year, the market feels really healthy.
Yeah.
It really does. Even earnings season we've had nice positive moves from stocks, nice positive numbers, but also at the same time we're having companies that aren't doing great. It feels very well balanced, not lopsided.
Great. Yeah, so thanks, Luke. We're running up on time, so I think we should wrap it up. And I just want to make a note for all of you out there. Luke and I want to get in front of you every 2 weeks, just just to give you our perspective on what we're seeing in the markets and in the headlines, and just to add the Presidio perspective of what we're seeing out there. We don't have a crystal ball. We can't see into the future, but we could be held accountable to tell you about what our ideas are and things that we might want to discuss with you when we come to investing in your portfolio. Before you make any investments, make sure that you sit down with your investment advisor to come up with a strategy or amend that strategy. So don't take anything that we say here as a recommendation to go take any action without talking to your financial advisor. Okay, and so we'll talk more of that in future episodes, but I think it's really important. Make sure you get a plan, right? So whether you're that person we talked about a couple episodes, sitting on the sidelines, wondering what to do, cash is a problem, right? For me, it's a sign that something is broken and we need to fix it, right? And so Luke and I are here to help you if that is you. Also, if you're all in and you're very aggressive and you don't have any fixed income and you don't know if you need to, and what is fixed income and what is the bond market, that's another trade that we see a lot of people need some help understanding. So, cash on the sidelines is a sign of a problem that needs to be fixed. We can help fix that problem. But again, investing is very, very difficult. We talk about game-changing technologies. I was talking to another client about, would 3D printing be in the future? Is video conferencing technology going to be in the future? Is video conferencing medicine going to be in the future? Is autonomous driving going to be in the future, right? Or cell phones?
Sure.
All of these things, right? We can say, oh, I think that is a great area for investment, right? Whether that means a particular company is going to stay dominant or whether they're worth the money that they are charging to buy into that company, so to speak, right now is another question, and it's very difficult.
I would just add, I've heard this comment said a few times just in media recently, and it really, really resonated with me just based on my studies, is that it's been proven time and time again that investing for the long term and creating wealth in your household is a relatively efficient process versus trying to get rich exceedingly quick.
Yeah.
And so this all just dovetails into a plan, investing, advice, long-term, meeting your goals. It's not the market's not always going to go up.
Yeah.
It's not. In fact, we'll have our pullbacks, but
but stay on the path, keep moving forward. Try not to get distracted by shiny objects, running off and blowing up your portfolio. Meet with your investment advisors so that you make sure that you're good for the long haul. So that's great,
right.
Luke. Awesome. Well, we'd like to thank everybody for tuning in. Please, if you would, subscribe to our channel here to make sure that you don't miss any future podcasts and episodes. Also, we'll have replays available, so if you do miss one of our live performances, you'll be notified when the replay is available. Just go ahead and click the button and subscribe to our channel. You can also follow Presidio Capital Management on Facebook and Instagram to get access to more content and timely news and topics that might be of interest to you. So, Luke, thank you, my friend, for joining me here today. As always,
Cheers.
It's always a pleasure. And we have some new exciting segments coming your way in future episodes. We'll talk about that soon. Everybody take care. We'll see you in a couple weeks.
Make sure to wear your red on Sunday.
Oh, yeah. All right. Either way, I think you're wearing red, right? All right, guys. Have a good one. Thank you.
All right.